Hey everyone, welcome back to the channel. Today we're re-diving deep into a topic that often seems complicated but is super important for long-term financial planning. Whole life insurance? You've probably heard the term thrown around, but what does it actually mean? Is it the right choice for you? By the end of this video, you'll have a crystal clear understanding of what it is, how it works, and who it's best for. So grab a coffee, get comfortable, and let's demystify whole life insurance together. First things first, what exactly is whole life insurance? At its core, it's a type of permanent life insurance. The word permanent is key here. Unlike term life insurance, which only covers you for a specific period, like 10, 20, or 30 years, whole life is designed to cover you for your entire life, as long as you keep paying the premiums. The premium amount is typically locked in when you buy the policy and stays the same for life. This predictability is a huge plus for many people. No surprises, no sudden increases. You know exactly what you need to budget for, year in and year out. But whole life insurance is just about the death benefit that your loved ones receive when you pass away. That's a common misconception. It actually has a second powerful component, a cash value account. Think of it like a built-in savings or investment vehicle. A portion of every premium you pay goes into this cash value account. Over time, this account grows at a guaranteed, fixed rate set by the insurance company. It's a slow and steady growth, but it's reliable. Plus, this growth is tax-deferred, meaning you don't pay taxes on the gains as they accumulate. This dual-purpose nature protection plus savings is what makes whole life insurance unique. So, let's break down how this cash value component really works. Imagine you're paying your monthly premium. Part of it covers the cost of the insurance itself, the part that guarantees the death benefit. The rest is funneled into your cash value account. This account earns interest, and some policies may even be eligible for dividends. Dividends are not guaranteed, but they are a share of the insurance company's profits paid out to policyholders. You can use these dividends in several ways. You can take them as cash, use them to pay your premiums, or even use them to buy more coverage, which in turn can accelerate your cash value growth even faster. One of the most attractive features of the cash value is its accessibility. You can borrow against it. Let's say you have an unexpected emergency, like a major home repair or a medical bill. Instead of going to a bank, you can take a loan from your own policy's cash value. The interest rates are often more favorable than traditional loans. And the approval process is simple because you're essentially borrowing from yourself. You don't even have a strict repayment schedule, though it's wise to pay it back to keep your full death benefit intact. If you don't repay the loan, the outstanding balance will simply be deducted from the death benefit when you pass away. You can also make withdrawals from the cash value, but this will permanently reduce your death benefit. Now let's talk about the pros and cons. Because like any financial product, whole life isn't a one-size-fits-all solution. On the pro side, the biggest advantage is its permanence. You have guaranteed lifelong coverage. You buy it once, keep paying, and you're set. The fixed premiums offer stability and predictability for your budget, which is a huge relief for many. Then there's the forced savings aspect of the cash value. For people who aren't disciplined savers, it's a great way to build a nest egg automatically. The tax-deferred growth and potential for tax-free loans are also significant benefits. Finally, the death benefit is generally paid out to your beneficiaries, income tax-free, providing them with a lump sum of cash when they need it most. This can be used to cover funeral expenses, pay off a mortgage, fund a child's education, or simply replace your lost income. However, there are definitely some cons to consider. The most significant one is the cost. Whole life insurance premiums are substantially higher than term life insurance premiums for the same amount of coverage. This is because you're paying for lifelong coverage and funding that cash value account. For a young person on a tight budget, a whole life policy might be too expensive, and they might be better served by getting a larger amount of coverage through a more affordable term policy. Another potential downside is the relatively low rate of return on the cash value component. While it's guaranteed and stable. So, who is whole life insurance really good for? It's often a great fit for individuals who are looking for lifelong certainty and have a long-term perspective. If you have a high net worth and are concerned about estate taxes, a whole life policy can be a crucial part of your estate plan. The death benefit can provide the liquidity your heirs need to pay those taxes without having to sell off other assets. Like a family business or real estate, it's also a solid choice for people who want a disciplined, hands-off way to save for the long term. If the idea of managing your own investments feels overwhelming, the forced savings mechanism of a whole life policy can be very appealing. It's also suitable for business owners who need to fund a buy-sell agreement. This ensures that if one partner passes away, the remaining partners have the cash to buy out the deceased partner's share from their family, allowing the business to continue smoothly. Lastly, it can be a good option for parents or grandparents who want to leave a guaranteed financial legacy for their children or grandchildren, regardless of what happens in the stock market. It's about creating generational wealth and providing a safety net that will be there no matter what. Now, let's contrast it a bit more with term life insurance, as this is the most common point of confusion. Term life is pure protection. It's simple, it's affordable, and it covers you for a set term. If you pass away during that term, your beneficiaries get the payout. If you outlive the term, the policy expires, and there's no payout and no cash value. It's like renting an apartment. You have a place to live, but you're not building any equity. Whole life is like buying a house. Your payments are higher, but you're building equity, the cash value over time. You own it for life. The best choice depends entirely on your personal situation, your financial goals, and your budget. For many people, a combination of both might even be the ideal strategy. You could have a large term policy to cover your biggest financial responsibilities during your peak earning years like your mortgage and raising kids, and a smaller whole life policy for permanent needs and long-term savings. So, how do you decide if it's right for you? First, assess your needs. Why do you want life insurance? Is it primarily to replace your income for your family if you die prematurely? Or are you also looking for a long-term savings vehicle and estate planning tool? Second, look at your budget. Can you comfortably afford the higher premiums of a whole life policy without straining your finances? It's crucial not to overextend yourself. A policy is only good if you can keep it in force. Third, consider your investment style and discipline. Are you a savvy investor who is comfortable managing your own portfolio, or do you prefer a more conservative, hands-off approach? Answering these questions honestly will guide you toward the right decision. It's always a good idea to speak with a qualified and trusted financial advisor or insurance professional. They can help you analyze your specific situation, run the numbers, and compare different policies from different companies to find the best fit for your unique goals. Don't just rely on a single source of information. Do your own research, ask lots of questions, and make an informed decision that you feel confident about. In summary, whole life insurance offers a powerful combination of lifelong protection and a tax-advantaged savings component. It provides certainty with its guaranteed death benefit and fixed premiums. However, this certainty comes at a higher cost and with lower potential returns compared to other investment options. It's an excellent tool for specific goals like estate planning, business succession, and creating a guaranteed legacy. But it's not the right choice for everyone. Understanding the nuances is key. It's not just about good or bad, it's about right for you. I hope this detailed breakdown has cleared up some of the confusion surrounding whole life insurance and has given you the knowledge to explore whether it fits into your financial plan. Thank you so much for watching. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on personal finance and wealth building strategies. And don't forget to hit that notification bell so you never miss an update. If you have any questions or want to share your own experiences with whole life insurance, please drop a comment below. I love hearing from y'all. See you in the next video.